Australians invest far more in deposits than in bonds than their counterparts around the world. Now, in the past this made sense, but new regulations and falling deposit yields makes for the case for a more balanced allocation of their investments between deposits and corporate bonds. So take a look at this graph. It'll show you how Australians invest for retirements when compared to other nationalities. A few things stand out. First, Australians invest more in equities, in particular locals equities. Now this makes sense from a tax perspective. The dividend imputation system in Australia is rarely found abroad. Second, at face, Australians appear to have a strong preference for deposits over bonds. Now at Spectrum we see this more they use deposits as part of their overall fixed income or bond allocation. Both are debt instruments. Now the supposed over-allocation to deposits makes sense. Post the 2008-9 GFC, banks in Australia were encouraged to increase their deposit bases to give the perception of perceived stability of funding. To do so, they paid up for deposits. And they paid up to the level, of course, what corporate bonds would be offering. Add to this, you had, of course, the safety of a government guarantee for many deposits. You combine these factors, an easy decision to allocate more of your money towards deposits rather than corporate bonds. Nowadays, though, the banks have exceeded their regulatory needs. In short, they've got enough deposits, and therefore they don't need to keep paying out to attract those deposits. And what we see now is more of a natural retracement of the yield difference between corporate bonds and deposits. Hence, you're getting more for your corporate bonds than you would for your average deposit at a bank. The second thing is the regulations have changed for deposits, making them a little bit less attractive. If you want to put a term deposit in place, that's fine. But if you choose to break that, you need to give the bank 31 days notice. This is a change of the past where you can just break a deposit at will. The other changes, of course, is the banks are encouraged not to give you the interest earned up to that date of the break. So if you're an investor who wants some of your portfolio to be safe and ready accessible, a corporate bond fund may be part of that solution as opposed to keeping your low yielding deposits. And if you look at this following graph, you'll see the difference between your savings accounts or short-term deposits and corporate bond gap is becoming quite large. Now we stress that corporate bonds are typically riskier than deposits, so keep that in mind. But when you're looking at what you need, returns you're looking for, your liquidity, and a changing environment, it's not hard to see why investors around Australia, particularly superannuation investors, are increasingly switching more of their money from term deposits and into corporate bonds. If you'd like any more information on this subject or on Spectrum, please go to our website on spectruminvest.com.au. Thanks.